Good morning, everybody. Welcome to the Investment Subcommittee on Wednesday, 19th of April 2023. We're a little late in starting. It's 10:10. First item on the agenda is apologies. Now, I've received apologies from Mr. Clark and Mr. Bill. The next item is the minutes of the meeting held on the 12th of October 2022. I propose that the minutes of the meeting held on the 12th of October are taken as read, confirmed and signed. Is everybody in agreement? Thank you. Yeah. The agenda item 2 is question time. I have received no questions. Next, we have questions asked by members under Standing Order 7.3 and 7.5. I have received no questions. We've now come to agenda item number 4. To advise any other items which the chairman has decided to take as urgent elsewhere on the agenda. I've not been notified of any urgent items. Agenda item number 5, declarations of interest in respect of any items on the agenda. Does any member have any interest to declare? I wouldn't imagine they would have. No. Okay, so on to agenda item number 6. Cash deployment, strategic asset allocation update and infrastructure investment top-up set out on pages 9 to 16 on the agenda. Bhulesh, our Senior Financial Analyst Investments, is here to present this report. So, Bhulesh, over to you.
Thank you, Chair. So you'll have seen this report in the past, and the purpose is to update on the cash holding of the pension fund and its plans for deployment against the SAA. You remember the committee updated the SAA for 2023 in January, and the last part of this paper is to provide some background regarding commitments to 3 infrastructure investments. Just moving down a bit of background here, 6, 7 and 8 talk about last year's approvals. So we've got April 2022, subcommittee approved investment to Central's direct property fund. We'll talk about that again going forward. Number 7, at the July ISC, we approved, the committee approved investments to JP Morgan's infrastructure fund, Central's Core Plus infrastructure fund, a net zero fund from Quinbrook, a new manager, and Stafford's Carbon Offset Opportunities Fund, pending further due diligence, which has now been completed. And then the final ISC last year, the ISC approved multiple investments into the private debt asset class with commitments to Central's low return product and Central's real assets product, as well as an existing manager partners group with their multi-asset credit Fund 7. Point 10 looks at our current cash holdings as at the 31st of December. They're much lower than they have been in previous years. We're at about 97 million as at the end of 2022 and at 74 million as at the time of writing this paper. It's about 1.7% if you look at the 97 million and a bit lower at the 74. Owing to the positive cash flow nature of the fund, we will always be bringing money in as a result of paying pensioners and dependents less than money coming back into the fund. It's easier to keep cash lower owing to the commitments made during 2021 and 2022 that we just talked about. Point 13 is a reminder of the SAA that we approved at the January meeting. There's a number of key changes highlighted there on the right. We've got the 4.5% decrease to listed assets, listed equities, a slight increase to private equity, plus 1.75, which takes it to 7.5% of total assets, a decrease of 2.5% to targeted return, taking it down to 5% of total assets, an increase of 2.75% to infrastructure, taking it to 12.5%, which is earmarked from the previous year. The other changes are more minor than those. Looking at point 14, a table that we've seen before shows our current allocation against each asset class, what our benchmark strategic asset allocation was in 2022 and in 2023. And then you can see the differences. So the work we have to do to try and align that during the course of 2023. We've made good inroads into closing the gaps to the 2022 SAA. We have some shortfalls in private debt and property, but approvals and commitments are in place to close those. In 2023, we've got 3 primary areas to address, and that's reducing the growth assets weighting, particularly within listed equity and targeted return, both of which on today's agenda. And then the other part also talked about within this paper is addressing the increase in the infrastructure allocation. So what are our plans for 2023? We've got a table at the top of page 13. If you can see it on your screens, it's quite wide, but you can see for all of our asset classes a number of columns there. First one being our actual holdings as at the 31st of December 2022, and then we've got what we plan to do in columns 6, 7, and 8, the 3 that are together, starting with commitments approved, cash flow that we expect during the year, and future ISC changes. We don't have many in the future ISC changes. We haven't approved anything as such yet. But you'll notice in the commitments approved column, we've got quite a lot of commitments to infrastructure, global credit, and property. These are the points we talked about in the previous parts. So we've got estimated 239 million pounds in infrastructure outstanding commitments, about 300 million for private credit, and 120 to close that gap and that section of portfolio where we were underweight. Again, a table that you'll have seen on previous papers is the effect on cash to March 2024. So this is estimating where we expect to be, and we try to hold as little cash as possible. It's not easily done all the time because of the nature of money going in and out, and the fact that we're a cash flow positive fund. But as you can see, as at the 6th of April, we had 74 million. We roughly expect to be about the same come the end of the year. We've got a lot of ins and outs, but we expect a lot of commitments to be drawn from the approvals we've made in the last year and a half or so. The second part of this paper is the infrastructure underweight proposals. So we've got, as at the end of the year, we had a 130 million underweight to the infrastructure class if we look at the new 12.5% weighting for infrastructure that was approved at the January meeting. The fund has 8 infrastructure managers we could allocate to, 6 of which are open for new investment. As at the July 2022 meeting, Hyman's proposed a framework which is shown at point 34, which helps us decide where to allocate. So the framework looked at risk factors and by geography. We had within the risk factors, we wanted 70 to 90% within core or core plus infrastructure. So that's the less risky part of that, and then 10 to 30% in the value add or opportunistic space. And by geography, we wanted 10 to 30% in UK and 60 to 80% within developed overseas markets and up to 10% in advanced emerging markets. Now, looking at that and speaking to our existing managers on where they wanted to allocate, we've come up with a list of 3 here that would meet that framework. So we're proposing 35 million to LGPS Central's Core Plus Fund, 20 million to the JP Morgan Infrastructure Fund, and 45 million to the Quinbrook Net Zero Power Fund. Allocating those would give us the allocation to the right risk and geographies going forward. It's not the whole amount, it's 100 of 130, and we can reassess that later in the year. All things being equal, we may or may not need to add a little bit more, but it's best to hold a little bit back at this stage, we feel. The final point there is that the JP Morgan Fund and the Quinbrook Fund are denominated in dollars, so the actual recommendation is for a dollar commitment. Happy to take any questions.
Okay, thank you, Bush. Has anybody got any questions? No? Oh, Subir.
Thanks, Bush. Interesting paper, and I think I've manage to follow it, hopefully. Just a couple of points. The cash position, just in terms of in the interim while you've got those cash balances, where are they held?
So they are swept up each night and held within money market funds. There was a time where we wanted very little cash. Obviously, there is no allocation to cash within the SAA. That was during a time when rates were next to zero, so holding large amounts of cash wasn't really useful. It's not the case anymore. We earn near enough base rates to the cash holdings now.
These are overnight. Okay. And then the second point is on paragraph 35. The table, I think there's a split for by risk and by geography. I'm sorry being pedantic here, but the by geography elements, middle of Hyman's target, those should add up to 100. It's 95. And if we update that, I'm not sure what actually changes in terms of the difference. Does that change any of the commentary?
No, I mean they're not supposed to add up to 100. The point is we can be anywhere within those ranges. We just can't have more than 100 overall.
Okay, so that 5% could be the cash element. Partly, no. That's just the way I came up. Read it. So the by risk is 80 and 20, so 100.
No, I mean we could have a an allocation range that said you could go up to 50% in the UK and you could have up to 100% in overseas. But if you went to 100% overseas, the other one would have to be a zero. So you can see that they don't have to particularly add up to 100.
So that probably being pedantic, but I just wanted to make sure.
That's okay.
And then a final point, in terms of the recommendations, and I think it's a theme that's going to probably come out throughout the other papers as well, is these decisions we make now. And on the previous conversations we had in the local pensions committee around net zero commitments, etc., those decisions are being made with those sort of requirements, if you want to call it, centrally at the heart of what we're trying to do. Because in due course, we'll be asked to demonstrate and evidence the decisions we've made that are leading towards supporting net zero by 2030.
Yeah, of course. Every decision we make now takes into account all the risks that we have to think about, and climate risk and our net zero strategy is just another one of those risks that we take into account. So you'll notice on here there is a further allocation to the net zero power fund, which will help. But that's not the only reason we choose that fund.
If I may, just one more point. The timing, just the timing in terms of when the SAA was signed off and when we approved the net zero strategy. To what extent are we held hostage, if you want to call it, to the SAA? Because that came before the sign of net zero, and sort of any flexibility we have around, basically whatever movements we can make and how transparent we might have to be about that.
I could see Philip's itching over there, but just to say, when we wrote the SAA in January, the work to write that SAA had started before. I think we first looked at it in September the year before, which is a fairly standard timetable for the fund. We've assumed that our climate strategy and net zero strategy would be approved, and Philip's been party to that discussion along the way. So the Hyman's team are fully aware of the journey we've been on and have built in as many options as we could possibly have. Anything further, Philip?
The only other thing I would add is that yes, we did take into account where we expected the fund to be in terms of its net zero objectives and climate strategy in the SAA. But the other thing I would add is that it's not just the SAA that determines the fund's climate risk profile. And in fact, what we're finding is that it's the way in which you implement each of the individual asset classes that has a much bigger impact on climate risk than the SAA itself. So, for example, in the listed equity review, you'll see we're proposing a reduction in emerging markets. That's entirely within what was agreed at the SAA, but that happens to be extremely helpful as far as climate risk is concerned. So, and we'll see lots and lots of examples of the way you implement the strategy being more important than the SAA itself.
Okay, that's clear. Has anyone else got any other questions or comments? Mr. Pitt.
Thank you, Chair. Paragraph 29, talk about the management expenses. It says 5 million used to pay towards paid directly, and the balance majority fees are paid from the investments held with the managers. I just wondered, do we get sight of how those investments are divested?
I think they're not divested as such. What we're saying is some fees are paid directly by the fund, so that we're billed by the manager, and other fees are paid within the fund's returns. So you get returns out which are net, and the expenses are deducted within the fund. And that's the key difference I think you're picking up on there. Unless I misunderstood your question.
Well, I just wondered if there were any investments that are sold. How is the balance of fees funded if it's not from cash?
So some are from cash, which is the 5 that are shown here.
Yeah.
And others are paid by the manager within the fund. We don't have to divest assets to pay fees. We're a cash flow positive fund as such. Yeah, that help.
So if you think about this sort of, I don't know, maybe the only investment to hold yourself, when a manager's got his investments in different shares and things like that, they're going to generate dividend income, etc. So instead of him almost reinvesting those, he'll take it from those as a first call. So I think they're trying to avoid as much as they can what selling. But if you think it's sort of just through the natural management of the fund anyway, they're going to be buying and selling in investments periodically, so they can just manage that process. So, but it's probably more a case of they're not investing more rather than actually having to sort of sell out. But they'll keep their strategy pretty much intact, as it were.
Okay, happy with that. All right. Any other questions or comments? No, we haven't. Oh, Zubi.
Apologies. Just on paragraph 22, there's reference to the performance in the emerging market exposure. LGPS Central Fund has not had. Fund has not performed as expected. Some of the reasons set out, and there's one point D, which is saying, by their own admission, central conviction is two managers significantly weaker than they were first appointed. Is there? Oh, sorry, apologies. 21. Oh, sorry, apologies.
Yeah, no, it's all right, Zubi. I think you're ahead of us all. Just hold on. So, any other questions on this paper? No. All right. So, we're asked. We're recommended to approve an additional 35 million commitment to the LGPS Central Core Plus Infrastructure Fund, bringing the total commitment to 135 million. We recommended also to a $24 million commitment to the JPMI Infrastructure Fund, which is equivalent to about 20 million, and a 54 million commitment to the Quimbrook Net Zero Power Fund, split equally between the main fund and the co-investment fund, and that's equivalent to 45 million, roughly. Is that agreed? Is everybody happy? So that's unanimous. Thank you. So I've just agenda item 8, any other items which the chair has decided to take as urgent. As I stated, there are no urgent items. The next meeting of the investment subcommittee is scheduled for the 26th of July 2023 at 10 a.m. That doesn't mean we finish this meeting. We're going to go into private session now. So the public are likely to be excluded during consideration of the following items in accordance with Section 100A4 of the Local Government Act, exempt information. So we are now moving into private session. Is that agreed by everybody? Yeah, so that's agreed. So there are no people.